Hey, what's up, guys? Welcome to Accounting with Karim. Welcome to transaction number two. And so, for transaction number two, on January 2nd, John, the owner of the sole proprietorship, purchased an equipment for $7,000. So, let's look at how this affect the accounting equation and also the accounts that are impacted. Okay, so on January 2nd, purchase of equipment for $7,000. So equipment went up by $7,000 because that's an asset that's coming into the company, and cash went down by $7,000 because that's an asset going out the company. You're paying someone else cash, so that's a reduction to your asset side. Okay, so for this transaction, only the asset side is impacted. So there's no liabilities for this transaction. Also, there is no owner's equity for this transaction. So only asset, right? So the accounts that are impacted is equipment. So there's a debit to equipment for $7,000. So equipment went up by $7,000, and cash went down by $7,000. At the end of this transaction, this is a net impact or a net zero impact to total assets, right? Because equipment is also an asset, so that went up by 7,000, and cash went down by 7,000. This is a net zero effect to total assets. So initially, we had $15,000 into cash, right? That was the balance at the end of the first transaction. Now there's a reduction to cash. So at the end of the second transaction, cash is $8,000 here. But also equipment went up by 7,000. So 8 and 7 is 15. So we still have 15,000 into the asset side of the equation, right? So at the end of this transaction, total assets still 15, and owner's equity still 15, liability is 0. So the equation is still balanced. And so see you guys in transaction number 3. Cheers.